A little more than a half hour to go till the opening bell on Wall Street. And joining us right now to talk about the recently rallying markets is Emily Roland, the co-chief investment strategist at John Hancock Investment Management. Emily, we've been watching earnings come in, and I guess so far so good.
Yeah, definitely. There's been a relief valve released, I think, as far as earnings go. Of course, we've seen the financials come in better than expected. Definitely benefiting from really good comps on a year-over-year basis. We look at the Fed funds rate, which averaged 1.25% in Q2 of last year, and in Q2 of this year, well north of 5%. So huge benefit there. We also broadly saw improving economic growth in the second quarter with GDP looking to come in positive about 2.5% per the Atlanta Fed. We've got consumer spending on track. And then we've got the banks benefiting from this deposit flow due to the regional bank issues. So definitely some relief across markets. I think we're seeing the broadening that we've been looking for, with financials starting to participate, regional banks looking like they may put in more of a durable low. So certainly some positive developments.
You point out, though, that this is a situation where expectations have been low. The bar's been lowered. You're looking at earnings per share expected to be down 7.5% from what we'd seen before. And you think this is the low bar for earnings expectations for the rest of the year. It's going to get tougher from here.
Yeah, when we look at analyst estimates and FactSet, they are penciling in Q2 as a low for the year. Q3 is expected to be flat. Then we start to look at positive in the fourth quarter, 8%, and then 13% penciled in for 2024. That would all be fine, except we're looking at valuations that are already reflecting those positive earnings estimates. So the S&P 500 now trading at above 19 times forward earnings. And if you look at the returns in the S&P 500 this year, 16 out of the 17% that we've gotten is all from multiple expansion. So we think that those estimates might be a little bit overly optimistic where we see the macroeconomic environment going. We've had a great couple of weeks for the markets, but it might be time to think about rebalancing into some areas that have frankly been left in the dust. Nobody's had a need for more defensive equities. They're now on sale. We like areas like healthcare and utilities as places where the baton could potentially be passed into the back half of the year.
Right. What else? What about equities versus bonds? How does that debate or that kind of back and forth shape up? Which do you like better?
Yeah, frankly, we see the valuations a lot more compelling on the fixed income side today. We talked about the PE ratio, but if you think about the earnings yield on the S&P 500, 5.2%. And meanwhile, we're looking at the yield on investment grade corporate bonds as more elevated than that. You're looking at 5.5% there, even shorter term bonds showing elevated yields. So we do think this is an opportunity to potentially let bonds do a little bit more heavy lifting in portfolios. I know that's a really tough sell this year, given that we've seen these great returns across stocks. Investors are starting to capitulate. They are tired of fighting this market. Momentum is there. We get that. So we want to be invested in stocks, but we think bonds from a valuation standpoint represent a really great entry point today.
So you're not calling for a pullback in stocks?
Not necessarily. Look, momentum is a powerful force, Becky. We know that. And again, we're seeing investors starting to join the party here. Disinflation has been a key reason for that. Markets are celebrating that. Look around. You see it everywhere, whether it's CPI, PPI. You're looking at the biggest declines in used car prices in history over a month-over-month basis. The prices paid components of the survey data. I could go on and on about disinflation in the pipeline. And one thing that's been impacting is currency markets. You've seen a bit of weakness in the dollar starting to play out as that disinflationary trend gets priced in. And that's been really responsible for a large part of this risk on rally. When the dollar weakens, everything goes up. That's been a pretty consistent pattern over the past year. So as you continue to see that disinflationary trend come in, you could consider, continue to see markets rally.